It'll be interesting. Said the president is advocating for this.
Yes.
Right?
Yes.
Do you have the what he actually said here?
All that he did was post a picture of himself
Okay.
with a 50-year mortgage
Okay.
below. So it's
That's
literally
the
just a
topic.
meme. Literally
It's
just a
not
picture.
no spoiler.
Right.
50-year mortgages.
Yeah, 50-year mortgages.
Right.
And then he did an interview where there was a little more discussion about it.
Okay.
So I think that Trump thought it was going to be a little bit of a throwaway, like, hey, here you go, guys, throwing us a bone. And
Right.
we were all like, that's disgusting.
This is terrible.
So, but let's try and steel man it a little bit here. So I assume that the difference between a 30-year and a 50-year, wow,
It sounds pretty easy.
I can qualify for more homes, right? And this is the attempt is to address the affordability crisis that we have.
Correct. Which is the crisis.
Yes.
To be really clear before
Yes.
we go on.
So to address the affordability crisis, we increase the loan term and then
Right.
people can qualify for more.
Right.
Sounds great
Right.
until we start putting it on paper.
What?
Yeah. So here's a little bit of rapid fire information. So the differences between a 15-year and a 30-year, the private mortgage insurance is going to be more. It's going to be
The
higher.
borrower has to pay this.
Borrower has to pay private mortgage insurance in their monthly payment when they put down less than 20%.
Right.
Okay. If you put down more than 20%, you don't have PMI.
Right.
Okay. But most individuals that are struggling with the affordability crisis are going to be putting less down as well. Okay.
Correct.
So let's assume you have PMI, which is very reasonable. All FHA loans have PMI regardless of how much you put down. Okay. So the difference between a 15-year and a 30-year, the PMI is higher actually with a 30-year.
Okay.
Okay. Additionally,
Why is that?
so the banks,
For a borrower. Like,
Yeah.
How long would it be?
yeah, the bank explanation is that it is a riskier product
Okay.
to do a 30-year mortgage, which does make sense.
Sure.
If I'm loaning you $20 for the next 5 minutes versus the next 5 years,
Got it.
I'm much more comfortable with the
That's a
getting
great
my money back
explanation.
in 5 minutes.
That's a
So,
great- Okay.
so for the bank, they charge more.
Because the term extends,
Yes.
it's riskier.
More
More things can
mortgage insurance. It's referred to PMI, private mortgage insurance.
Very good.
So the PMI is higher. Additionally, for the exact same explanation, the interest rate is higher as well.
Yes.
So when I go from a 15-year to a 30-year, PMI goes up, private mortgage insurance goes up, interest rate goes up.
Sure.
Now, these details have not been revealed for the fabled 50-year mortgage. However, it is
Pretty legendary.
very reasonable to assume that the PMI and the interest rate are going to be higher as well.
Yes.
All right. So how does this impact things?
Yes. Really.
So-
we've run the math. You did the math.
We did, yes. Let's actually go ahead and assume, just for the sake of argument, that there is no change in the private mortgage insurance in these. So let's say all things being equal, all that happens is the loan term extends to 50 years.
Okay.
Okay. So that, and using just some general numbers, a $350,000 loan, pretty reasonable for where we're at these days, for a 30-year, including the private mortgage insurance.
Mhm.
So this is excluding taxes and homeowners insurance. Again, sorry to get complicated, but just want to be clear. The monthly payment would be $2,315. This is
Okay.
for a 30-year.
All right.
Okay, 350 loan. If we do a 50-year, that payment drops down to $2,067. So that's a almost $50 difference in the payment.
Mhm.
That's not nothing.
No, it's
not
not
bad.
that substantial.
Yeah.
Okay.
That's an 11% change in the payment. Now, here's what I think people would really care about. So if we're out shopping for a home and I'm qualified for $310,000, that's the max I can qualify for. We're out shopping for homes for $310,000.
That's tough. Yeah.
We see a home that's $350,000.
Mhm.
Go, oh man, I really want to qualify for that. Well, guess what? Based on these numbers I just described, no change to rate and PMI, I would be able to qualify for that $350,000 home by
So
doing
$40,000 increase
$40,000 increase by going to the 50-year term.
if the terms didn't change, right? If
Now,
the interest rate, right? Okay.
exactly.
Yeah.
Now, let's assume that there's going to be a reasonable change in the interest rate and PMI like we see from the 15-year to the
Yeah.
30-year.
Well, I think that's reasonable to expect.
So if the PMI and interest rate change, again, I'm trying to use very reasonable numbers, very conservative, with the difference. So again, the 30-year term, the payment was $2,315.
Mhm.
Let's adjust to a 50-year term and adjust the PMI
John,
and interest rate.
I'll hold you to it. Go ahead.
Yep. The payment for the 50-year term with the adjustment to PMI and rate is $2,353.
Gosh. So it went up.
It went up.
Oh gosh. And you have 20 more years on your mortgage.
And there's 20 more years on mortgage.
Well, not that people are paying off
No.
very often. But
So, and this is an important point. Let's go ahead and make this point real quick.
it is.
Everyone wants to point to the fact that you're paying, let's just say, again, round numbers, let's say it's a $500,000 home,
Yeah.
okay? You're going to pay about that much in interest over the life of the loan, over 30 years.
Right.
$500,000.
Correct. And if you go to 50,
it doubles. It goes to about $1 million. Yeah. So you're paying double.
But how many people do this, right? We know.
So this is the point, right? The average time in a home is about 5 to 7 years.
Yeah.
So you're not going to be paying. Now, here's what it gets you. The funny term, the amortization schedule,
right?
Okay, is every payment that you're going to make over the course of 30 years or 50 years is determined when the loan is originated, if it's a fixed rate. Sorry again to get a little confusing, but the amortization schedule, that is every payment that you're going to make over 30 years, the interest and principal that you pay changes over the life of the loan.
Right.
And can you guess what you pay more on the front end?
Interest.
Yeah. So you pay, let's say, and again, for a 15-year, you actually pay a little bit more principal than you do interest, which is a good thing.
Yep.
With a 30-year, it gets pretty lopsided. You pay a lot more interest.
Way the other direction.
And then
50, it's like, yeah. Right.
So you're paying tons of interest. The joke that my dad made was it's almost like an interest-only loan.
Oh, yeah.
How much interest you're paying relative to principal.
And to his point, it's kind of a joke, I get, but it's also kind of true if someone stays there like 5 years.
Yeah.
It may literally be.
Yes.
Just about all interest.
Yes.
And almost no principal. But
right.
Not that people are thinking, oh, I'm going to pay it way down in 5 years.
Right.
With a 30-year either.
Right.
I mean, 15, yes. But 30-year, you're not going to pay that much down in
right.
5 years' time. You know that.
Right.
Maybe some.
Right.
But yeah, it functionally becomes like an interest only loan for the average amount of time people are in houses.
Right.
So the point is, it's a bogus, ridiculous idea. We can put up the Family Feud, you know, the...
Oh, yeah.
Should you get a 15 more? Right? It's an awful idea.
Absolutely not. There's literally no benefit because, again, if the payment is...
to affordability or payment.
Exactly.
Or interest or anything.
If the payment is slightly higher, right. You're literally qualifying for less, actually.
Yes.
It's absolutely absurd.
It's horrible.
Right.
Okay, well...
Now...
debunk the idea that this could even be valuable.
It's completely absurd. Someone forgot to do the math, I guess.
So the only way it would make sense is if there was a bank willing to lend at the 30-year rate.
Yes.
Then you get some more affordability.
A little bit of a help there. And again, let's assume nothing changes. There's a 13% increase in your purchasing power if the PMI and rate don't change. Right. That's not nothing.
No, but we also know it's not going to happen.
Correct. Right. Why would a bank do that?
No.
Right. Now, the one thing that I would say, and this is what I think no one is talking about this. One thing that I think talking about the 50-year has exposed is honestly just how absurd of a product the 30-year mortgage is too.
It's true.
I'm just saying.
The other interesting thing I've always found, and it makes sense, I get why. If you're 80 years old and you go buy a house, they can't tell you can't have a 30-year mortgage.
It's ageist. That's correct.
Exactly.
Yeah, it is technically federally illegal to do that.
Correct. And so I think that's really fascinating to go, well, I can't get a 30-year mortgage. Like, yeah, you can.
Yeah, you can.
We've got a friend who's 70 buying a house right now.
Yeah.
You get a 50-year mortgage.
Absolutely.
If it was available.
Absolutely.
They can't say, well, you won't live, we've got these actuarial tables that they can't do that.
Now, you know what's funny is that part of mortgage guidelines, we do have to prove continuance of income.
Yeah.
So, but not continuance of life, apparently.
Correct. Well, anyway.
Oy.
You're right. It does prove a point, though. Even a 30 years is kind of silly.
Right.
Right? But that's become the standard.
Right.
For most people. If they're not buying cash, there's always a percentage of people getting 15-year mortgages.
Right.
But 30 is kind of the standard.
It is the standard.
Well, moving on. I think
that's
a good topic.
So that's our...
It's timely. It's trendy.
Yes.
Just like us.
Everyone's gibbering about it.
On top of it.
Yeah.
And I think it's interesting to talk about.
Yeah. And again, I think
it's a worthless product.
Yes.
Probably.
Yes.
We can say
It's
unless some bank comes with some creative way to use it.
Right.
Which is possible.
Right.
Just not probable based on what we've seen in our experience.
Mm-hmm. Yep. Really, and just final point I would say is the affordability crisis is a big deal.
Yes.
It's a big deal.
Oh, very
and I think it's horrible. And in my mind, the only way that you could have an impact on the affordability crisis is way more supply, which would mean that house prices would be impacted. And I'm not saying you should do that. I'm just saying the way that the levers work, we need more supply. That's the only thing that
prices just quickly. Prices do continue to kind of move down a little bit, just kind of overall. I'm not talking about like your neighborhood. You're watching this, you might think, oh no, not our area.
Right.
hold on.
Yeah.
Sure, I understand. You may live in a neighborhood that's not happening.
Yeah. And if that's the case, I'd love for you to comment below. So that
Yeah, by and large, though, the prices are inching downward. They're relatively stagnant. They're not really going up or down a whole lot. They did drop a lot from the peak. They've come down 20%, maybe,
Right.
so give or take, or more.
Right. From being inflated 50%.
But even with all this extra supply, they're still just kind of holding in there.
Oh, yeah.
Because people have amount of money they need to make or want to make, whatever the case may be. So that's one reason they've been stubbornly high.
Yeah.
Rates are stubbornly. A lot of reasons rates are stubbornly high.
Yeah. Which we can talk about some other time. We'll give some more information about that next week.
Yes.
But government shutdown and then
Yes.
blaming government shutdown for perpetuating these is some interesting stuff we can break down next time.
Okay, that's good. That's good.
Very good. Bam, moving on. Yep. Insert a cool effect.
Yeah, please.
Or, of course,